Self-funded insurance. Well, there's a lot of different names for self-insurance. There's self-funded benefit plans, there's self-insured plans, there's partially self-insured plans. They all basically mean the same thing. And essentially, in a self-insured or a self-funded benefit plan is a method for an employer to pay for the health insurance program that he's offering his employees. In a self-insured medical plan, an employer doesn't necessarily have to pay his own claims. What they do is they hire an administrator, a third-party administrator, like Insurance Administrator of America. Our job in that capacity is to take the member phone calls, the provider calls, process all the claims for the employer, and give them the reports and the information that they need to make good business decisions on what benefits to offer their employees, not only today but in the future. Well, self-insured plan is different than a traditional fully insured plan for a lot of reasons. The biggest reason is that it gives the employer the ability to design a benefit plan that meets his particular employee's family's needs, and his budget, of course. A traditional plan is where the employer pays the insurance company a premium each month, and at the end of the year, the premiums are kept by the insurance company regardless of whether they were used or not. In a self-insured plan, the employer keeps the premiums that he typically would have paid the insurance company in his bank account or her bank account, and only pays for claims that their employees incur. The self-insured plan doesn't have to pay for a lot of the costs related to a fully insured plan, such as the insurance company's overhead costs. Perhaps they have a heavy marketing expense built into the plan, reserves that they have to keep in the premiums, state premium taxes, and a big expense that most people don't realize is each state has certain benefits that are mandated and must be included in the insurance company's program regardless of whether employees need it or not. In a self-insured medical plan, you don't have to include state-mandated benefits because this plan is controlled or regulated under a federal guideline rather at the state level. With that being said, one of the other big benefits of a self-insured medical plan is that all the employees that are covered under your plan have the same benefits regardless of what state they live in. So for an employer that has multiple state locations, they have one benefit plan that they can offer all their employees. I'm often asked what employers typically want a self-insured plan. Well, our best success is with the entrepreneur, the employer that has 50 employees to say 500 employees. They're businessmen and they understand that insurance companies aren't the most efficient entities out there. And they know if they can take control of their benefit plan, design it in a manner that's going to meet their employees' needs, they're going to satisfy their employees. They're also going to have a less costly way of providing health insurance plans to their employees. With a self-insured program, we can have 1, 2, 3, 4 different plan design level of coverages. What does that mean? Well, I can go into an employer group and provide them with a benefit plan that matches their current benefits exactly. And I can also provide them a different level of benefits that may have a higher copay, it may have a richer prescription plan, and it may also include a flexible spending account. So there's a lot of variables there, there's a lot of ways to provide the various needs of the employees under one program that the employer can provide. When we discuss self-insured health plans with employers, one of their biggest concerns is, what if I have somebody that gets really sick and they have to go in the hospital? Well, in our industry, we call it a catastrophic claim or a shock claim. And there's ways to mitigate or reduce the risk in a self-insured medical plan. And the easiest thing to do is for the employer to purchase excess loss insurance. Excess loss insurance is a type of insurance that essentially protects the employer against any claim in excess of a certain dollar amount. And this dollar amount is a predetermined dollar amount. It could be $20,000, $25,000, or $30,000. How does this work? Well, if an employee or the member goes into the hospital and we get a claim in our office for $100,000, the employer in a self-insured plan might fund the first $25,000. What happens at $25,000 is then we have an insurance company come in and they fund the balance of the claim that's due the hospital. From an employer's perspective, they know that they will never spend more than a predetermined amount of money. Typically, if you're interested in a self-insured plan, you want to contact a third-party administrator. The third-party administrator has a staff that knows how self-insured plans work. They know how to process a claim. They know how to set up a reinsurance program. They know how to design a benefit plan. They also know how to answer your members' questions. They know how to work with doctors. The idea here is to help the employer keep the process simple and the work on his side to a minimum. For more information on the self-funded health plans and coverage options available from IAA, visit IAATPA.com or call 1-800-283-4600. 888-2524 and speak with a self-funded leader.